inflation figures.
Soaring prices for everything.
Cost of living pressures.
The inflation figures crucial to any Reserve Bank decision on rate cuts.
Most people think that no inflation. It's the price increases we hear about so often in the news. But what if I told you this figure has fundamental flaws in reflecting Australians' true cost of living? In today's video, we will uncover what's really behind those inflation numbers, review what's left out, explain how the RBA uses inflation for rate decisions, and break down what it means for everyday Australians. First, let's get clear on what inflation is and how it's measured and used in Australia. Inflation happens when the prices of things we buy go up over time, causing our money to lose purchasing power and buy fewer goods and services than before. In Australia, inflation is measured using the Consumer Price Index, CPI. The CPI looks at the price changes for a basket of goods and services that most households spend money on. This basket is divided into 11 categories: food and non-alcoholic drinks, alcohol and tobacco, clothing and footwear, housing, furnishings, household equipment and services, health, transport, communication, recreation and culture, education, insurance and financial services. Each category carries a weight based on how much Australians spend on it. For example, housing has the biggest weight because rent and utilities are a large part of most budgets, while communication has a smaller weight. The Australian Bureau of Statistics (ABS) updates inflation data regularly. They publish the quarterly CPI, which includes all items, and a monthly CPI indicator, which updates prices for about 2/3 of the basket. In Australia, the CPI is extensively used by various sectors. The Reserve Bank of Australia (RBA) uses it to guide interest rate decisions. The government relies on it for fiscal policies, including budget planning, social welfare adjustments, and tax policies. Businesses use the CPI to forecast costs, adjust pricing strategies, and negotiate wage increases. Individuals and unions refer to CPI figures in wage negotiations and cost of living adjustments. Sound robust? Wait until you hear what's actually not included in the CPI figure. Housing currently makes up around 22% of the CPI basket. It includes rent, new dwelling purchase, maintenance and repair of dwelling, property rates and charges, water and sewage, electricity, gas, and other household fuels. At first glance, you'd think this covers all the essential costs of having a roof over your head. But it doesn't, not even close. New dwelling purchase has the largest weight in housing, but its name can be quite misleading. Many assume it includes the price increases of owner-occupied properties. It's easy to think that buying an existing dwelling is still a new purchase, therefore it should be part of this new dwelling purchase in the CPI. But that's not the case. If you buy an existing dwelling, about 69% of properties sold in Australia in 2024, you are not included in the CPI statistics. When I say new, they don't mean new purchases, they mean new dwellings, newly constructed homes with no prior sales history. Think of those off-the-plan apartment buildings and houses built from scratch. Here's where it gets even trickier. Even if you buy a newly built home, the CPI doesn't capture the increase of the full purchase price. The land value component of your new home is excluded because it's considered an investment. The CPI only captures construction cost increase of the new home, which includes building materials, labor, and builder margins. In fact, before 2017, only the construction cost increase of newly built detached houses were captured in the CPI. The construction cost increase of newly built apartments and other attached dwellings such as townhouses have only been included since 2017. When property prices rise in Australia, a significant portion of that increase is attributed to land value appreciation. Yet our inflation figures completely exclude the cost of land. But here's a question: how can you buy a home without buying the land it sits on? That's not all. Do you see any mortgage repayments on the housing? No, because they are not included in the CPI figures either. To put this into perspective, about 37% of Australians own a home with a mortgage, and their struggle with skyrocketing mortgage repayment in recent years due to increased interest rate are not reflected. So if you're a homeowner with a mortgage, a new buyer who fought tooth and nail to enter the market, or an aspiring homeowner trying to buy a property, much of your experience is left out of the official inflation statistics. That is a significant portion of the population whose financial reality isn't fully captured. Talking about a significant chunk of the population being left out, did you know that the CPI only measures price changes of items in Australia's 8 capital cities? It does not measure price changes in regional, rural, or remote areas. According to the ABS, 33% of Australians live outside these capital cities, meaning another significant portion of the population's inflation experience is completely left out of the CPI figures. Cities and regional areas have different cost dynamics. Regional transport costs are often higher due to longer supply chains, and limited services like healthcare create unique financial pressures. With regional areas excluded from the CPI, RBA decisions and government policies might not fully reflect the challenges faced by a third of Australians living outside capital cities. Another important nuance worth knowing about the CPI figure is that it reflects the average household's spending pattern. But how many of us are truly average? Spending patterns can vary a lot depending on factors like income, lifestyle, family size, and even where you live. For example, a young professional living in a city might spend a larger portion of their income on dining out and entertainment, while a family in the suburbs might allocate more to groceries and school-related expenses. The CPI tries to capture the big picture, but it often misses the unique cost pressures that many households experience every day. If you like this video so far, I think you're gonna love what's coming up next. But don't forget to like and subscribe. The headline CPI is frequently cited by the media and government, but did you know that the Australian government can actually buy a lower CPI? The logic is simple. If a government policy temporarily reduces prices for items with significant weight by subsidizing the price, it can lower the headline CPI figure.
The Prime Minister knows that could put voters in a much better mood when they go to the ballot box.
An example of this is energy rebate. The Australian government is providing $3.5 billion to extend and expand the Energy Bill Relief Fund and provide electricity bill rebates to Australian households and eligible small business electricity customers in 2024 and 25 financial year to ease cost of living pressures. Some state governments are offering their own rebates to help residents with energy costs. With the rebates, electricity prices fell 9.9% in the December quarter and 25.2% in the past 12 months. This significant drop in electricity prices has played a crucial role in lowering overall inflation figures. Excluding these rebates, electricity prices would have risen by 0.7% in the September 2024 quarter and 0.2% in the December 2024 quarter. While it's the government's role to manage living costs and alleviate household burdens, the concern is that such temporary measures don't address underlying causes of inflation. Those electricity rebates we mentioned will end by the 30th of June 2025, which is likely to lead to a rebound in inflation figures once they are removed. While the RBA's flexible inflation target is for the headline rate of inflation to be between 2 and 3%, it places greater emphasis on the trimmed mean inflation figure, which is the average rate of inflation after trimming away the items with the largest price changes, both positive and negative. It provides a view of underlying inflation by reducing the effect of irregular or temporary price changes that can impact the headline CPI. The RBA acknowledged that measures of underlying inflation are more likely to reflect the future course of inflation and are useful for forecasting headline inflation.
The board needs to be confident that inflation is moving sustainably towards the target, and for this to occur, we need to see more progress on underlying inflation coming down.
So whether trimmed mean inflation stays between 2 and 3% plays a key role in rate cut decisions. I'm not here to predict whether the RBA will cut interest rate in February, but based on the latest inflation figures, we are not there yet. Of course, the inflation figure is not the only factor the Reserve Bank considers for interest rate decisions. Other key considerations include the tight labor market and international risks, such as geopolitical tensions and potential tariffs from the Trump administration. Look, even if the CPI comes down to 2 to 3%, we must remember this doesn't mean prices are falling. It just means they are rising more slowly. It's like climbing a steep hill that you desperately want to get back down from. You finally reached a gentler slope, and while the climb isn't as harsh anymore, you're still moving further and further away from where you started, the baseline you are hoping to return to. Today's reality is built on years of rapid price increases. A lower inflation figure only means the increase is less steep, not a reduction in the cost of living. Don't get me wrong, this video isn't here to discredit the CPI. It's a vital tool for tracking inflation and guiding big decisions like interest rate. However, the link between the inflation figure and the real cost of living experience of Australians are broken. So what does this mean for you? Don't let the CPI figure give you a false sense of reality. If you're paying off a mortgage or trying to buy a home, it's likely your cost of living is rising much faster than the CPI's 2 to 3% target. Relying on the CPI as a benchmark can create unrealistic expectations. If you think everyone's costs are only rising slightly, but your own experience is far worse, it can feel overwhelming and even lead to frustration or depression. Instead, focus on your own personal financial situation. Track your expenses, set realistic goals for your budget, and plan for the big costs that affect you the most. Stay grounded and stay informed. Australia needs an honest conversation about the real causes of the financial pain many households are feeling. As the election approaches, it's more important than ever to make choices that support the long-term interests of everyday Australians. If you enjoyed this video, you might also like my other videos on the Aussie economy, covering both big and not so big topics. Thanks for watching. I'll see you over there.